Hello. Okay, this is working. Hopefully it works. Hello, I'm Seok KWON from Korean Insurance Development Institute. Today, I'm going to talk about Korean Insurance Development Institute and rate-making practices. Let's take a look at the contents of today's presentation. First, I'm going to explain what the Korean Insurance Institute Development or KIDI is and what it does. Second, I'm going to talk about how KIDI make insurance rates with the statistical data such as the national data and insurance data. Last, I'm going to explain how to make insurance rates when you don't have insurance data. First, what is KIDI? As a general overview, KIDI is a non-profit organization founded on legal basis of the Korean Insurance Business Act, Article number 176. Under the Act, insurance companies are obligated to cooperate with KIDI and submit their insurance data regularly. KIDI was first established as a non-life insurance rating organization in 1983. In 1989, however, it was renamed the Korean Insurance Development Institute upon expanding to encompass life insurance as well. And as you can see, KIDI aimed to protect the interests of policyholders and contribute to the development of the insurance industry. Currently, KIDI has 42 member companies, including 24 life insurances and 18 non-life insurance companies. We have 10 directors, 2 executive directors, 8 non-executive directors, and 2 external auditors. Today, KIDI is made up of approximately 230 employees. These charts sum up KIDI's organizational structure. KIDI is made up of 5 service divisions: planning and management, long-term products, property and casualty insurance services, and information and consulting services. It is also important to note that we have an automobile research facility, CART, as a subsidiary of KIDI. All of our divisions aim to protect the interests of policyholders and contribute to the development of the insurance industry in different ways. But today, I'm going to explain the work of KIDI's long-term product division non-life insurance team because that's my team. So let's talk about KIDI rate making. One of the main responsibilities of my team is reviewing rates and products. When insurance companies develop new risk rates, they are required to request KIDI review the appropriateness of their terminology and adequacy of data they use to develop the rate. Once KIDI verifies the rate, the insurance company can use the rate to develop new insurance products, which they will then request KIDI reviewing using the new product's basic files. The basic file, the product's basic files are what KIDI calls the required, sorry about that. The product's basic files are what KIDI calls the required document in the development of the new insurance product to ensure that premium rates are consistent with the insurance term offered and validate various calculations, including premium rates and reserve level. Once KIDI verifies the reasonableness of premiums and accuracy of reserves, the insurance company must file to FSS, the Financial Supervisory Services, with the KIDI's verification documents. So what type of insurance rates are there? There are 3 different types of insurance rates: new rates, experienced rates, and reference rates. New rates are new insurance rate that the insurer develops. Experienced rates are new insurance rates that are adjusted by insurance experience claim data. In this way, new rates become experience rates. Reference rates are industry average rates developed by KIDI. New rates. New rates are new insurance rate developed by insurer. They are calculated using various data such as national data, foreign data, disease work, and insurance data. There are more types of data, but these four are these four are the most common used to develop new rates. National data is data published by Korean national institutes such as the National Health Insurance Data, National Cancer Center data, and Statistic Korea. Foreign data is data published outside of Korea, such as the US National Institute of Health and US National Cancer Institute. Thesis work is individual academic research work undertaken to prove the viewpoint of the researcher. Insurance data is insurance claim or accident data. So, how do we calculate new rate using these data? To calculate new rates, we need to divide the number of risk units by the number of exposure units. The risk unit is either the frequency or frequency times the severity unit, depending on what kind of risk rate we're calculating. Let's look at the example. Let's say we're calculating mortality rate. So there's a QX, which is the risk rate, and QX is either frequency or frequency times severity over the exposure unit. The mortality rate is how many people died within a certain period of time. Can people die more than once or more severely than others? No, that is that. So we must use frequency, not frequency times severity. Then what's the frequency of mortality rate? Number of deaths. What's the exposure unit of mortality rate? Population. So to calculate the mortality rate, we need to divide the number of deaths by total population. Simple, right? Let's look at another example. Sorry about that, I have a dog. Let's look at another example, hospitalization rate. So same as before, there is a QX, which is risk rate, and QX is either frequency or frequency times severity over the exposure unit. A hospitalization rate is how many people are hospitalized within a certain period of time. But this is very important. Will everyone be hospitalized for the same number of days? Let's say there are two people, A and B. A was walking down the street and fell into a manhole and broke his leg. B was driving 150 kilometers per hour on a highway and got into an accident. He probably broke his legs, hips, spine, and more. Would A and B be hospitalized for the same amount of time? No, B will be hospitalized much longer than A. We have to apply this risk into the rate. So hospitalization rates are frequency times severity, not just frequency. Then what's the frequency and severity of the hospitalization rate? The frequency will be the number of people hospitalized, and severity will be the total number of days hospitalized. So to calculate hospitalization rate, we need to divide the number of people hospitalized by the total days of hospitalization by the total population. These are the two of the simplest example of calculating new rates. It gets much more complicated depending on the type of risk rate, but I won't go into detail today. It's important to remember that even when you're calculating mortality rate or hospitalization rate, you should consider every factor carefully and calculate for all known variables. For example, male and female rates will be different. So when possible, calculate two mortality rates, one for males, one for females. Age is an important factor as well. Someone 100 years old will be more likely to die than someone 30 years old. average mortality rate and hospitalization rates like we calculate are useful, but you will get more accurate rates when you consider all possible factors. I'll I'll talk about this in details later if we have enough time. So let's move on to experience rate. Experience rates are rates adjusted by the new rate using insurance claim data. Why do we adjust new rates into experience rates? We develop experience rate to reevaluate the appropriateness of new rate for the current situation of both the insurers and the policyholder. In other words, we're making the risk rate more suitable to the real world or current period. Applying disease trend, underwriting tactics, and applying loss ratio are three most important reasons for adjusting new rates into experience rates, among others. Disease and accidents trend change every year. Let's say that company A developed a contagious disease rate 5 years ago. Their risk rate is probably going to be low since contagious disease don't occur very often. But let's look at our contagious rate in 2021. Do you think that rate developed 5 years ago would be accurate today in current climate? No. Why? Last year, with the outbreak of COVID-19, a lot of people were infected and passed away. We're still suffering from COVID, and now scientists are saying that there will be more disease like COVID in near future. So we have to reevaluate. The contagious disease rate that was developed 5 years ago was an accurate rate at the time, but not anymore. So we need to apply this disease trend to make the rate accurate for today's world. The second reason we need to reevaluate new rates is to just wait. The second reason we need to reevaluate new rates is to apply the company's underwriting tactic. When we calculate a new rate, such as a hospitalization rate, we don't apply underwriting tactics because we don't have the necessary data yet. Also, companies can change their underwriting tactic at any time. Let's say there are people A and B. A is very healthy 40 years old man, and B is very sick 40 years old man with a lot of chronic disease such as a heart disease, diabetes, and more. A and B both want to get the same insurance product. I'm pretty sure A can get it, but B cannot. Why? Because from the perspective of insurance company, it's too risky to sell their product to B. But according to the new rate, A and B are the same. So we need to apply this insurance company's underwriting tactics to make the risk rate more suitable for the company. This way, A can pay fair price for his insurance product. The last reason to reevaluate the new rate is to apply company's loss ratio. As mentioned earlier, when disease trends change it will affect company's loss ratio. In the earlier example, company A lost a lot of money because of COVID-19. They should adjust to a higher risk rate to maintain enough premium to manage the company. On the other hand, because of the COVID-19, the risk of getting the common cold went down because everyone is wearing masks, which means company A is getting too much premium for their common cold product. They should lower the rate to benefit their policyholders. In these ways, by adjusting new rates into experience rates, we can make premium more fair for both insurance company and policyholders. Then, How do we calculate experience rate? There are two different methods to calculate experience rates, the loss ratio method and the pure premium method. The loss ratio method adjusts risk based on the actual loss experienced, and the pure premium method is sum of the losses divided by the number of exposure unit. It's very hard to understand without looking at the equation, so let's look at some equations. First, let's look at how to calculate experience rate using the loss ratio method. The experience rate equals the new rate times the rate changes. Simple, right? Then what's the rate of change? The rate of change is the total losses over the total premium earned. In other words, the total money paid out divided by the total money earned. Total earned premium is calculated by number of policies multiplied by the new risk rate. So the experience rate is the new risk rate multiplied by the total losses divided by the number of policies multiplied by the new rate. We can cancel out these two new rates in the equation, and we're left with the total losses divided by the number of policies. Does this sound familiar? When we look at the definition of the pure premium method, it is the sum of losses divided by the number of exposure unit, and the exposure unit of experience rate as a pure premium method is the number of policies. In other words, the total losses divided by the number of policies, the same as the loss ratio method. Theoretically, the loss ratio method and pure premium method should be the same, but because of other factors such as credibility and trends, the final experience rate will be different depending on the method. Now let's talk about reference rate. Reference rates refer to industry average rates. So why does KIDI calculate reference rates? Since it's an industry average rate, it is an adequacy rate for the policyholder's perspective. Small companies can use the reference rate to make the product, so it is easier for them to enter the industry. From an insurance supervision perspective, they can always compare the insurance company's new rate with the standard and stable reference rate to supervise the rate. So how do we calculate reference rate? Just like calculating experience rate, we calculate reference rate using the loss ratio method or pure premium method. Experience rates are calculated using companies' claim data, but reference rates are calculated using multiple companies' claim data. KIDI reviews and calculates reference rate based on the experience statistic of life insurance and non-life insurance companies. As I mentioned earlier, KIDI is a non-profit organization legally based upon a Korean Insurance Business Act Article number 176. Under the Act, insurance companies are obligated to cooperate with the KIDI and submit their insurance data. So KIDI collect policy-based data from insurance companies and create experience table and reference table. Once insurance companies send policy-based data to KIDI, KIDI calculates the reference rate by using the loss ratio method or pure premium method for the life and non-life insurance. Then KIDI files the reference rate to FSS, the Financial Supervisory Service. Once the reference rate receives approval from FSS, KIDI provides the reference rate to the insurance companies. Now let's talk about how to make insurance rate without insurance companies' claim data. When you don't have any claim data, you will need to develop a new insurance rate until the insurance company collects enough data to get their experience rate. What kind of data can we utilized to calculate this new insurance rate? Earlier, I mentioned insurance company data, national data, thesis work, and foreign data. But there is an order of priority for using this data. This is not universal rule, but an order of priority of data that KIDI has set in our calculating new rates manual. The order of priority may differ according to your situation, company, or country. The highest priority data is, of course, insurance company data. If there's enough insurance company data to utilize, it is best to use it since it's it is best to use it. I'm sorry. I need more water. It is best to use it since it contains company's underwriting tactic. It will be the most accurate data for company, but if the company doesn't have enough claim data, national data is the second top priority. If the insurance company is trying to sell their product internationally, they should use foreign data, but otherwise, national data is going to be the most suitable. Let's say we're trying to make motorcycle accident rate in Korea. We cannot use the Vietnamese national motorcycle accident data because the number of people who ride motorcycles in Vietnam is way, way higher than Korea. So if we use Vietnamese data, the rate will be probably too high for Korea. If the US were to use the Korean obesity rate, their risk rate would be too low for the US. Also, risk of certain disease can be vary by race. For these reasons, KIDI has put national data as its second highest priority after insurance data. KIDI's third highest priority data is disease work data. There are so many different kinds of disease data, but two of the most common disease data that insurance companies use are incidence and prevalence data. Incidence data is very hard to find in national data, so insurance companies often use the incidence prevalence ratio from disease data. IPR, incidence prevalence ratio, is the number of new occurring disease in population divided by the number of people living with the disease in the same population. So if you're calculating diabetes incident rate, it will be the number of diabetes patients divided by the population using national data. That will be the diabetes prevalence rate. Next, multiply IPR by the diabetes prevalence rate to calculate the diabetes incidence rate. This is how you can utilize disease data. When it is so helpful, why isn't it better than national data? Because the number of patients used in disease work is usually much smaller than in national data. As per the law of the large numbers, the larger the sample, the more accurate the data. This is why disease data is our third priority. Our last priority is foreign data. This is the data we use when we cannot find the data we need within our own nation. Developed countries have more data in various fields, so we can use their data to make brand new insurance rates. For example, one Korean insurance company used foreign data to develop a risk rate based on health age instead of birth age. Because foreign insurance companies had already utilized health data to calculate health age before Korean companies ever did. Risk rate based on health age is is a calculated risk based on your current health instead of your birth. Using this, individuals can have more accurate weight based on their health. Now, KIDI has developed a health age calculating model, so we are using our own model instead of foreign country data. But when you don't have national data yet, you can use foreign data to calculate new risks. Statistical data is statistical data is of utmost importance when calculating risk. Without data, calculating risk is impossible. There are more types of data than what I mentioned here today, and I wouldn't say that KIDI's methods and prioritization of data is the only way. So make your own manual or standard for calculating risk and data prioritization and stick to it. Thank you so much for listening, and I hope this was helpful. Thank you. Bye-bye. How do I stop this?